Well, it's been years since the collapse of Lehman Brothers, which signaled the start of the global financial crisis. U.S. and European regulators have taken some steps to crack down on large banks taking on too much risk. However, many experts warn another financial crisis continues to linger. CCTV's Shraysi Tandon is live in New York with more. Shraysi?
That's right, Karina. 5 years after the financial crisis, U.S. regulators have been trying to enforce some tougher laws to ensure that banking system across the U.S. is more robust. They're trying to make sure that banks across the U.S. are taking on less risk, that they're less leveraged, and that they're less interconnected. But some Wall Street veterans I spoke to today say that 5 years on and the banking system is still not where it's supposed to be, and that potential systemic risks are still present.
On September 15, 2008, the collapse of Lehman Brothers, the largest bankruptcy filing in U.S. history, triggered the worst financial crisis since the Great Depression. 5 years later, many experts believe that some of the factors that triggered the financial crisis haven't been fixed. Last week, former U.S. Treasury Secretary Henry Paulson was asked if the U.S. is in danger of another financial crisis. Paulson said, quote, "That's the question I've been most frequently asked since I left Treasury. The answer, I'm afraid, is yes." While the amount of capital at some of the largest U.S. banks has almost doubled since 2008, many Wall Street veterans say it's not enough. They still see a financial system that's too complicated and far too interconnected to prevent another panic.
The interconnectedness is enormous, and in fact, one would argue perhaps worse than it was back then because the institutions are larger. We still do not have, and there's enormous resistance on the part of financial institutions to furnishing real-time information on intercompany obligations, really what one company owes to another company. So it's very, very difficult to regulate the sector.
Wall Street has made some changes under new regulations, such as America's so-called Dodd-Frank financial reform law and the Basel III capital rules, both written to discourage banks from risky behavior. Still, a recent Reuters Ipsos poll shows an anti-Wall Street sentiment that continues to persist. According to the poll, 44% believe the U.S. government should not have bailed out financial institutions, while only 22% believe it was the right thing to do. 53% think little was done to prosecute bankers, and only 15% were satisfied with the efforts. Although U.S. regulators have taken steps to discourage banks from excessive risk-taking, many economists warn that big risks remain.
One of the flaws with the Dodd-Frank bill is that it actually says that you can't bail out banks, that you have to resolve them, meaning you have to seize them and wind them down. A large bank can't actually stop functioning. You would actually cause the same problem again. The way things stand right now, until these final regulations are fully promulgated and in place, we are still very much exposed.
Karina, it's not just the U.S. regulators that have been coming down hard on the big banks. In fact, the European regulators are also trying to enact some of the same reforms. But as many critics point out, the 2012 bank bailouts in countries such as Greece, Spain, and Cyprus show us that some of the world's banks are still too big to fail. And if that policy continues, experts do warn us that we could see another global financial system meltdown 5 years after the financial crisis. Back to you.